We're looking at a possible trade setup for earnings in Ring Central, ticker symbol RNG. Stock right now is at 437.85. And just looking at a chart real quick, we saw quite a bit of consolidation late last year into early February, and we saw a move higher from about 380 up to about 445. They do have earnings tonight, and I'm looking to set up a trade that will benefit from bullish to neutral price action for the rest of this week. There are 3 days until expiration this week. So what I'm looking for, number one, I'm looking at what options are currently pricing in. We can do that by adding two at-the-money options. We're going to add an at-the-money call and an at-the-money put. So we can use a 440. 440 call is going for $13.15. 440 put is going for about $15.25. So give or take about 30 points in either direction. I'm going to place an out-of-the-money short call spread, 5 wide. This would be, and I'm going to place my short strike at around 40, maybe 35 delta. 450 happens to be a delta of 38, so I'm selling a 450, buying a 455, and I believe that call spread is going for 225. All right, so I'm taking in 225, and my risk in this trade is a 275. So now, if Ring Central does not move more than what is priced into the upside, I will capture $2.25 worth of premium by the end of this week. However, this leaves me with upside risk if we do see a move to the upside more than what is currently being priced in. If we see a move to 460 or more, I have a potential to lose $2.80 on the upside. So to cover my upside risk, I want to go out and sell. Normally, I would sell one out-of-the-money put that will cover my upside risk, because, in my opinion, the stock is a little bit stretched. It's currently trading about over 2 ATR from the mean, which is a 21 exponential moving average. I want to go a little bit further out of the money on the puts, and I'm going to sell 2 naked puts for every 1 short call spread. So I need to sell 2 puts that will give me a total credit of more than $280. So I will look to sell maybe 2 of the 390s. Right, so now I don't have any risk on the upside. All of my risk is on the downside. And my downside risk is that if the stock is below 390 by Friday of this week, I am facing the risk of getting long stock at 390 minus credit that I'm going to collect for this trade. So the credit here is about 480. So my downside break even by the end of this week is 390 minus $4.80. So the downside risk is down to about 387.80. Because the premiums are coming in a little bit right now, we are seeing a little bit of upside risk. So what we can do is we can actually move from 390 up to 395, still sell 2, and now we don't have any upside risk. All of the risk is to the downside, and downside risk is if the stock goes below 395 Friday on expiration, I have the risk of taking long position in this stock, and if I don't want to do that, I will need to buy back these 395s. But if I do end up taking stock, my cost in it is going to be 395 minus about 2.5. So my downside break even is at about 392. Best case scenario, we move less than what is expected to the downside. So if we're expecting about a 30 points worth of movement, maybe we'll go down to about 405, maybe 410, and don't go much lower. Premiums are going to get crushed, and I should be able to exit out of this trade in the next couple of days. On the upside, if the stock explodes higher, since there's no risk to the upside, maybe our short call spread will be in the money, which will be worth $5. But if I am taking in $5.65 total credit, I actually will end up with about a $65 profit if the stock is trading north of 455 by Friday's expiration. Again, consider your downside risk of owning stock. If you don't want to end up in that position, if you think the move is going to be much greater than what is currently priced in, this is not a trade you should be taking. If you think the risk is worth the potential reward, I think this is a good trade setup.